Welcome to Subramani. Uh, I was talking to somebody who said, how does one handle volatile markets? Actually, when people say volatile, what they mean is a falling market. If the market is falling, what to do? There is enough data to say do nothing if you don't know what to do, or if you want to panic, panic fast. So I keep saying that the minute you think that the market is overpriced or something, sell. You may be right, you may be wrong to the extent of a few days. Otherwise, you say, okay, I will just not bother. There is one theory which says just keep buying. So if you put together a good portfolio, maybe some equity, debt, maybe some real estate REITs, some gold, whatever, if you created that portfolio and you don't need the money for the next say 20 years, there is absolutely nothing to do. Just keep on adding to it. So you have added large cap, add mid cap, add small cap, doesn't matter. Don't bother breaking up by market cap. So keep doing that. So that's called the keep buying theory. You just keep buying when things when you need money, you see which is asset class doing well. So you pick up after 5 years, 7 years, whenever, and you see gold has given you 18% return or 20% return. You realize that gold should normally give you debt kind of returns, not equity kind of returns. Or it could, even if it is giving you equity kind of returns, the volatility is high. So you have to be worried about that. So that's a good time to remove money from gold if you need money. If you don't need money, then I'm not even saying do a reallocation of assets. You may be comfortable with being 75% in equity. That's fine. If you can manage it, it's not a problem. So how do you handle volatility? Largely the same advice holds true, that you stay calm and avoid emotional decisions. Now suppose you have bought some share at 200 rupees and that has now come down to 180 or 150, and you think, oh my god, let me average downward. You keep on averaging downward, it comes down to 60 or 70, and then you panic and you sell. So this is typically emotional decision, because you should not have averaged it down, or you should have the capacity to hold for a very, very long time, and therefore it would look good. But when you buy a share at a particular price, let's say you're a trader and you bought a share at 200 and you have a stop loss of 10%. So 10% means 20 rupees, 180 rupees you will sell. You just have a stop loss of 10%. Now if you're an investor, when the price goes down, the temptation is to average. But you say, okay, but at 25% down, so I will sell. So 25% of 200 is 50. So at 150 I'll sell, because I think the market is trying to tell me something which I can't see, something which I don't know, some risk which exists which I can't see, and therefore the price is 150. So for me, there is a stop loss even in my investment. So at 150 rupees I will sell it. Or after 6 months, if the price is around 200, exactly where it started, and it's not moving for whatever reasons, maybe the market is trying to tell me that maybe it was wrong for me to buy the share, then I can sell, but I should have some rules. So largely you have to stay calm and you have to avoid emotional decisions. This is obviously the first and the most important thing in a falling market, volatile market, bear market, whatever you want to call it. Second, keep assessing your risk tolerance. What happens is, during a bull market, everybody feels, oh, I can take so much of risk, it does not matter, I can take a 30% fall in my portfolio. Now when you have 1 lakh of rupees, a 30% fall means 30,000 rupees. When you have 1 crore, let's say you have 5 crores now, and you say, oh, 30% fall is okay. 30% fall is 1.5 crores. Do you realize that? I keep saying this to financial advisors. When the client says, I can take a 30% fall, and he has a 5 crore portfolio, you ask him or her, you're saying 30%, which means you can afford to lose 1.5 crores, right? And then they'll say, no, reduce it, maybe only about 1 crore. So suddenly that 30% was not registering in their head as 1.5 crores. So find out the client's risk tolerance, and if you're the client yourself, find out how much is your risk tolerance during good markets, bad markets, etc. It takes a long time for you to understand your own risk tolerance, right? So I keep saying investment is a know yourself journey. Very old theory, but yes, you have to know yourself. In the whole investing process, you tend to discover yourself. So find out what is your real asset, your risk tolerance theory, right? Third, which is said in the beginning, have a diversified portfolio, right? You have large cap, mid cap, small cap. I don't even like to break it up that way. So you have equity. You have Indian equity, you have foreign equity, you have value based equity, you have some growth based equity, whatever, however you want to dissect and bisect. Let us say you are 70% in equity, and that is what you like. You're 70% in equity, you're 20% in debt, and you're 10% in gold. I'm not getting into real estate, REIT, anything. You only have one property which you're staying and one property which you're using for your office. So I'm assuming that's all, and that's not your investment portfolio, that's your usage portfolio. So you have 70, 20 and 10. You just keep buying, right? So you have a diversified equity portfolio, very well diversified. So you keep buying. You say, oh, automobile is doing well, so I buy some automobile, or automobile should be there anyway in your portfolio. So Maruti is always there in my portfolio, or a Bajaj Auto is always there in my portfolio. So now it has fallen, let me buy more. Tata Motors has fallen for 40%, 50%, so let me add more, right? So because you have a good quality of portfolio, you keep doing this. So 20 years back also you were a buyer in Tata Motors. Today also you are a buyer in Tata Motors or Maruti, whatever, right? So that is what you keep doing. You have a diversified portfolio, but you can keep adding because some of these opportunities have come up. Similarly, some shares may have gone up. You may say, oh, I bought Indigo at 800 rupees, now it is 5,000 rupees, let me sell off. That's also perfectly right. Or you say, oh, Indigo has a great future for the next 10-15 years, so let me buy more of Indigo. That's also right. So diversify your portfolio and keep buying assets which have fallen. Right, that's a good way to look at it. Of course, during bad times, you realize the mistakes that you made in terms of poor quality of portfolio. You bought a poor quality of portfolio, you have to sell it. It does not matter whether you're in a bull market or a bear market. You could be in a bull market for you could be in a bull market for pharma and a bear market for automobiles. You're in the same market, right? One industry is not doing well, one industry is doing extremely well. So here you're in a bull market, here you're in a bear market. These are the times when these ratios show up, that the market cap of, say, Sun Pharma is greater than the market cap of the whole automobile industry. Then you know that the pharma industries are booming and auto is not doing well. It's a great time perhaps to get rid of some pharma and buy some automobile. So look at your own portfolio and take a decision based on that, but of course focus on quality, because during good times every piece of every share goes up, and that's not a great place to be in if you are a long-term investor, right? With all this, also keep some cash in hand, because the opportunity keeps coming. You bought a share at a X price, it's available at a lower price, or you bought Nifty at a particular price saying, oh, it's fallen 20%, then you find it has fallen even more, so you can average more. Averaging, please do only in the index, not even in a fund, right? Indexing, in index you can average, because let's say the mid cap index has fallen 30% or 25%. It's a great time to be buying, not because of anything else, because you know exactly when the market turns, this index will come up. Your fund managers, the fund may not come up as fast as the index, right? So keep your stop loss, make sure that it works, be unemotional about cutting losses, right? That's one of the greatest features of Rakesh Jhunjhunwala. Admit to yourself that you made a mistake, sell and get out, right? Whatever is your feeling. I mean, what prompted him to keep on holding on to Titan? I have no clue. He must have added also, right? So why? Because it was selling jewelry. Nobody knew that jewelry was going to become such a big business, right? So some things that you know, and something which allows you to buy more and more, and something which say, oh my God, I made a mistake, let me sell. All these are useful, and these are useful not only during volatile times, but during volatile times these are tested, right? Volatility looks bad if you have a short-term view. So somebody comes and tells me, sir, the market is down, should I buy? I said, you should always buy. If it's a good quality stuff, you should buy. If there is a company well run by a bunch of smart people, much smarter than you, in a technology which you don't understand, then talk to somebody else who understands technology, and that may be a good share to buy, right? So check out what works, what doesn't work. And my view is very simple. In 2025 or 2026, you are buying a share or you're buying a particular mutual fund at a particular NAV. Realize what will happen in 2045, right? So when I look at my portfolio and I look at some of the investments made in 2002, I look at it and say, I always say to myself, I wish I had bought more, right? It's never a question of, so this keep buying theory works, right? Especially if it is good quality. Stay informed does not mean that you have to look at your portfolio on an hourly basis and wonder what to do. Stay informed does just not mean that. Learn about what the market is doing. That's a different thing. I have not logged into my portfolio for a very long time. I've just not seen how my portfolio has been doing for a very long time. I just don't need to, right? Having said all this, if you're say 50-55 years of age and you have been investing on your own and you're not very sure, seek the help of a professional. Have your portfolio evaluated. See how to prepare for retirement. So at that stage, your ability to lose money and recover is less, right? So be careful about losing money after a particular age and after having created an X amount of wealth. So if you have say 30 crores with you, then you need protection of having a professional advise you on what to do. The risk is now too high. When you were younger, when you were maybe 22, you had only 5,000 rupees to lose, or 5,000 rupees was the SIP that you were doing, or maybe 500 it was. Because today if you're 60, 65, then obviously you must have started with a very small SIP of by today's standards. You must have started with 500, which was a big amount those days, right? So any of those things. So get a professional's help. It could be useful. Thank you.